So here's a crazy thought. What if Michael Saylor's Bitcoin strategy isn't as bulletproof as it seems? I mean, he and his company have gone all in on Bitcoin, more than anyone else in history. But what if their renowned Bitcoin Playbook backfires? Like, could this be the next Black Swan event that crashes crypto just like FTX did? Well, in this video, I'm gonna break it all down for you. The details, the risks, and the nuances, of course. And together, we'll figure out whether his Bitcoin strategy is a genius move or a ticking time bomb. Okay, but before we dive into the nitty-gritty, we gotta rewind a bit. You see, Microstrategy was founded way back in the late 80s, originally as a B2B SaaS company. At first, things were going great, and by the late 90s, it was in the right place at the right time to ride the dot-com bubble all the way to a $50 billion valuation. So that was awesome, right? But all this went downhill after they got caught up in a high-profile accounting scandal that tanked their market cap all the way down to around 1 to 2 billion, where it stayed for the next couple decades. Now, fast forward to 2019, and MicroStrategy was still around, but it really wasn't doing much, and its future seemed uncertain to investors on Wall Street. Now, what happened next was one for the history books, because when 2020 rolled around, everything changed. You see, the pandemic lockdowns were happening across the world, and the Federal Reserve was printing money out the wazoo to try to save the economy. Most companies were just trying to survive and navigate an uncertain market, but Saylor looked at everything going on and saw the opportunity of a lifetime to do one of the boldest moves in corporate history. In August of 2020, he announced that MicroStrategy would be the first publicly traded US company to make Bitcoin its primary reserve asset. Shortly after, he bought out all shareholders who were not on board with his vision and used $425 million to buy Bitcoin in a major sign of things to come. The response was both seismic and rapid, pumping its market cap from around 2 billion to as much as 10 billion before a correction finally came due to the collapse of FTX. But after the dust settled and the bullish sentiment returned, the MicroStrategy rocket ship picked right back up and has been soaring ever since. In the past year, MSTR exploded 500%, outpacing even Nvidia by nearly 3x, and it was able to take out its old all-time highs from way back in the year 2000. So after all this time, Saylor finally got its redemption and was able to prove his critics wrong by putting MicroStrategy back on the map. But wait, how is all of this possible? After all, there's no way he got that much success from just buying 400 million worth of Bitcoin, right? Well, if that's what you were thinking, then you'd be absolutely right, because MicroStrategy now holds over 400,000 Bitcoin valued at around $40 billion, which is 2% of the total supply of Bitcoin that will ever exist. And what's more is that every time I log onto X, it seems like Saylor is announcing yet another billion-dollar buy of Bitcoin. So something doesn't add up here, right? Like, how is this company with a middling software business able to buy that much Bitcoin and become one of the biggest holders in the world? Well, this is all made possible by their one-of-a-kind Bitcoin Playbook. You see, the playbook works like a flywheel, with each stage feeding the next in an ongoing pattern. To start the process, MicroStrategy issues debt/equity to investors and uses the proceeds of that to buy Bitcoin. This then helps drive up the price of Bitcoin, which makes MicroStrategy stock even more attractive, and that allows it to issue even more debt and equity, which is used to buy BTC, and round the flywheel goes. So that sounds simple enough, right? But when we dig into the details, now that's where things get crazy. But before we get at that, I first want to tell you about IoTeX, a project that's pioneering the DPIN revolution and was the first to bring a DPIN device on-chain. So recently, they launched their IoTeX 2.0 upgrade, which introduced a modular platform that can connect millions of real-world devices directly onto the blockchain. Key to that are tools like IOID, which gives off-chain devices an on-chain identity for easy tracking and data transparency, and WebStream, a decentralized network that enables off-chain compute and verifiability. So all that's super impressive, but IoTeX isn't just focused on the tech. No, they're focused on building an entire ecosystem. You see, their platform already supports over 50 DePIN projects and over 200 total integrations, making it the third largest DePIN ecosystem after Ethereum and Solana. For example, partnerships with projects like GeoNet are bringing 10,000 devices online for geomapping, and integrations with major networks like Solana and Polygon are expanding IOTex's reach even further. Right now, they're running a DePIN campaign called Get Goated, with 100 million IOTex tokens up for grabs. And their ecosystem projects are also allocating roughly $2 million worth of pre-TGE tokens as well. I'm talking projects like Network 3, GeoNet, etc. are all part of this campaign. So it's a great opportunity to explore the DePIN space while staking, trading, or completing simple tasks to earn rewards. If you're interested in any of that, then just check out my link in the description. Alright, back to MicroStrategy and the key details of their Bitcoin Playbook. So the first thing is that the debt that MicroStrategy utilizes is called convertible debt, which is a secret sauce here. If you don't know, convertible debt is like an IOU, but instead of getting your money back, you can also have the option of getting equity in the company. And it's this option that's crucial for this entire strategy. You see, the bond investor has the option to get equity if MicroStrategy stock reaches a certain price. But what's important to note here is that at this point, the bond investor is making a profit, which is exactly what they wanted in the first place. So this deal is great for MicroStrategy because if those conditions are met, then they don't have to pay back their debt with actual cash. As long as MicroStrategy stock keeps going up, everyone wins. The investor gets what they want, and MicroStrategy gets access to super cheap loans, which it might not even have to pay back. So Saylor calls this strategy intelligent leverage, as it amplifies returns when Bitcoin's price goes up, while investors are willing to pay a premium for this leveraged exposure, betting on Bitcoin's long-term growth. Now, this convertible debt is important, but the second piece of the puzzle here is the traditional stock sales. Usually, this would not be good for existing shareholders, as it dilutes the stock and could contribute to selling pressure. But in MicroStrategy's case, shareholders understand the game plan, which is to use these funds to buy Bitcoin so that the share price can go up, and also the BTC per share increases for all holders, which is the whole point here, to get more BTC exposure. But anyhow, that's their innovative Bitcoin playbook. But you know what's interesting? There's around a 2x differential between the market cap of MicroStrategy and the value of its Bitcoin holdings. This difference is called the NAV premium, which is basically the difference between the price of their shares and the value of the assets they hold. Investors who are bullish on Bitcoin are willing to pay this premium because they know that the funds will be spent on more BTC and they expect the price of their shares to increase as a result. But another key factor that contributes to this premium is MicroStrategy's place in the TradFi world. You see, MicroStrategy is doing a lot of stuff specifically for TradFi, such as offering convertible bonds, offering levered exposure to Bitcoin, etc., etc. There's not really another company that's offering these types of products, which is why many TradFi investors are buying MSTR stock even though there's a big premium on its net asset value. But regardless of that, this is great for us Bitcoin holders, right? Like, this is a big corporation literally going all in on Bitcoin and buying as much as they possibly can. But on the other hand, you must be wondering, isn't this all a bit risky? After all, they are literally borrowing and buying over and over again. Well, when you pick apart the playbook, there are definitely a few red flags that stand out. First off, we gotta talk about Saylor's intelligent leverage. Remember, this works by using convertible debt to help investors get increasing amounts of BTC per share, while pushing up the price of BTC and MSTR stock in the process. But for this to work, new issuances of convertible notes and stock need to be bigger than before, so that it will increase the BTC per share for current investors, which is the whole point here. This means that it's actually the new investors who are essentially paying for the benefit of current ones, which is why some people say that this smells like a Ponzi. Now, technically, in this particular instance, it's not a Ponzi, but you can see why people would think that, and it's definitely not a label that you want associated with your company. But regardless, the fact is that MicroStrategy must accumulate BTC at an accelerating rate, which of course brings its cost bases closer and closer to the current market price. Now, this is not a problem as long as Bitcoin keeps on going up, but as we all know, that's unsustainable. And if we see huge dumps come next bear market, then how much trouble would MicroStrategy be in? Well, at first glance, it actually doesn't look that bad, because MicroStrategy's loans are unsecured, meaning that they are not backed by anything, including its Bitcoin reserves. This means that there's nothing in the agreement that can force MicroStrategy to sell its BTC, in the same way that the bank can take your house if you don't pay your mortgage. However, this does not mean that taking on all this debt is a good idea, especially since the underlying company isn't making that much money from its software business. So let's say that the price of BTC fell and stayed below MicroStrategy's average buy price, which is currently around 60K. Well, this is where the real problems could begin, because such a drop would likely cause MSTR's price to fall, most likely by a lot. In fact, the price of BTC recently fell around 9%, and MSTR stock went down by almost 4 times as much. So this situation could lead to a sort of death spiral, as the more MSTR stock falls, the less likely it is to reach its target price for its convertible debt. And that would pretty much destroy the key advantage in this whole strategy. As the price falls and sentiment turns bearish, MicroStrategy could see its NAV premium disappear and find it much more difficult to refinance its debts, all of which would mean that it could lose access to the funds it needs to stop the free fall. So when this happens, it could potentially lead to a default, and that could lead to the absolute worst case scenario of having to sell its BTC. The signal that would send would be catastrophic, as it would deepen its spiral further and put the entire crypto space at risk. You see, as MicroStrategy owns so much BTC, if it started selling its reserves, then this would absolutely tank the price of BTC, sending panic throughout the markets in the same way that the collapse of FTX did. So this death spiral, with all these things feeding into one another, could cause a wholesale collapse of MicroStrategy and potentially crash the crypto markets to prices that we can't even fathom right now. Okay, so that may sound super scary, but how likely is it for this worst case scenario to actually happen? Well, I do think that we have to be careful here, because crypto is full of stories of companies that went to the moon but ultimately blew up due to their risky behavior. However, it has to be said that Saylor does seem like a shrewd operator who has been able to navigate this market in the past. In fact, he does have a track record of dealing with tough bear markets, even though his strategy back then wasn't as aggressive as it is right now. Either way, I do think that we have a bit of time, as their first loans do not mature until 2027, so I don't see any huge problems in the short term. However, their cheap debt won't last forever, and the real test will be how it reacts when that runs out. To me, it seems like there's going to be no middle ground here, meaning that either MicroStrategy will become one of the world's most successful companies, or it will explode in dramatic fashion. But what do you think about all this? Do you think that I'm tripping and that Saylor is a genius, or are you genuinely concerned as well? Let me know in the comments below. And also, if you want to hear some crazy stories from a Wall Street veteran who is now in crypto, then just watch my interview with Bill Noble right here.